Welcome to another episode of the Live Better podcast, sponsored by Centric Federal Credit Union. I'm Emma Baines, your host and social media coordinator at Centric. Today, we're shifting our focus to a topic that holds the key to numerous financial opportunities, mastering credit health. In a world where financial decisions are influenced by credit scores, understanding the nuances of credit health is crucial. Join us on this episode as we unravel the mysteries of credit scores, explore ways to build and maintain good credit, and provide you with practical strategies for mastering your credit health. Whether you're a seasoned listener or joining us for the first time, get ready to dive into the essential conversation around credit health. Let's explore how you can empower yourself with the knowledge to navigate the world of credit successfully. So I want to welcome all of our listeners to another episode of the Live Better podcast, and today we are joined by Kelli Green, who is a credit expert here at Centric. So before we get started, can you tell our listeners just a little bit about yourself and what you do here?
Yeah, well, thank you, Emma. I appreciate you having me here. It's fun coming back on the podcast because we talk about all kinds of fun things that are really beneficial to helping members genuinely live better. And so I have been at Centric, been in finance probably for about 16 years, at Centric almost 12 years, and I'm a mom of two. I have a husband. Let's see, what else is fun? I like to camp. I also love to ensure learning about all these things from a credit health standpoint, because my journey was not as pretty as it looks even today. It's still a journey, but I've walked through some really dark times financially, and if I would have had this, I feel like these tips and, just some guidance,
Right.
It would have looked a little bit different.
Yeah,
So,
I agree. So credit is a big topic, and like you said, you went through some dark times financially. I think we all probably have, and especially, at a young age when you're freshly married and you kind of don't have a clue what you're doing.
that's exactly right.
And the last thing that you know a lot about is credit. Like, what is that? I didn't learn that in school. I mean, everything I've learned has kind of just been on my own as time has gone on. And so I think equipping people with this knowledge at a young age is so important to help them avoid the mistakes that we made.
You're so right. And the sooner the better.
Yeah.
I think in anything that we do, from like grocery shopping to paying, your utilities, any conversations that you can have with your kids, do that.
Mm-hmm.
Even if it's they're doing different chores at home, and so you pay them $1,
Right.
or you just reward them in a ticket, and at the end of the week, y'all go get ice cream or something. Whatever it is just showing them so they can understand, hey, this is what this amount costs. This is what, you make an hour. How do you stretch that out? And just having the overall conversations, that's critical. You can never start too soon, in my opinion.
And I mean, just looking for like teaching moments with your kids. Like, it might you're just going through the motions with your bills and paying for things, but like there's always a time where you could stop and make it a teaching moment.
That's right.
Like, yeah, we could spend this on this today, but in 3 days, this bill is due.
That's right.
So if we do that, it might put us in a bind in a few days. So, I mean, just, talking about those things so they kind of understand what it's like to pay bills. But anyway, so let's talk about credit score. What is it? What does it mean?
Well, you'll hear a lot of people that will talk about, credit and why is that important, and to pay cash for all the things. You may hear different scenarios in which, I believe in a lot of those things as far as paying for cash, but the debt is not necessarily a bad thing, right?
Right.
It's really not. It's all contingent upon how well you manage that with the money that you have coming in versus your overall necessities. Like, I don't know about you, but it would be challenging for me to go buy a brand new vehicle, and just pay cash for that. But there are ways that you can, work up towards that. And so what does that really look like? And so that's really where your credit score comes into play, because we never know what future need that we're going to have. And really and truly, your credit score is just talking about your overall financial journey. It's how well, what your behavior is with money and with like just the overall capacity that you've been given. So for example, your credit score is made up of a couple of things: installment and revolving. Installment debt is really like a mortgage or a car note, because there's a fixed amount that's due at the same time throughout the month. Your revolving is more so your credit cards, where you have a particular capacity, your balance on your credit card, and that kind of fluctuates. So you have a large sum when you first open that credit card, but then as you start spending, well, then that balance, what's available to you, that starts dwindling down. And so your credit score really and truly is how well you are paying your bills. Are you paying them in full? And are you paying them on time?
Right.
So those are the things that are most important when really thinking about your credit score. Interesting enough, when we're having conversations and going through credit reports with folks, a lot of things I try to explain to them is, you want to see your history, the length of time you've had something open and how well you've managed that, that particular amount. So something I always share with folks is if you are, say you're opening up several new lines of credit, that's going to cause your credit score to drop.
Right.
Even if you're paying your debt off, I would not recommend closing them immediately because it's going to have a negative impact to your score. So what I mean by that is if you are paying off, say, 3 or 4 credit cards, close those relationships out anywhere between 30 and 45 days in between the other, because you're not doing such a shock and awe to your credit score.
Right.
And so even when it spikes up or even if it shoots really low, because when it shoots really low, it takes a little bit longer to increase it. But something people don't realize is that your credit score can drop almost 100 points if you have 30 days of no pay or late pay, so to speak. So it's really interesting. It's time is something you really want to pay close attention to in the regard of the length of time you've had a card open. So I still have the very first credit card that I had whenever I was in college, the very first one I ever opened, and I still have it. I hardly ever use it, which is not, I won't say that's the best practice of doing it because I just have a lump sum that's sitting out there. But that still tells the creditor that I have the potential to go into that amount of debt. So you have to keep that, in mind. My suggestion is it really just all goes down to the individual what is their relationship with money? Are you a compulsive shopper? Do you utilize credit cards to get through the month? Is this the way that you are really trying to, bloat yourself, essentially? I think that's a dead end road, right? You're heading into disaster. So those are some things to think about. Now, are you looking at, say, hey, you've got a credit card and during this, time frame, right now we're having double rewards points. Usually we do that a couple of times throughout the year at Centric. But are you just trying to put everything on your credit card just to, accumulate those points to use those for later on throughout, the year or even now for Christmas? And you have full intentions of paying off that debt at the end of the month. That just goes back to the person and what is your cash flow like throughout the month. So your really truly your credit score tells a lot about your behavior, your relationship with money.
And so this is the way I kind of look at it. You tell me if I'm wrong. So I kind of think of credit score as like a grade in a class. I mean, your grade in, say, your math class is going to tell anybody who looks at it, kind of, for the most part, how well you know that subject.
That's right.
And I mean, this is kind of the same thing. So that I guess your credit score could be more like, what is your mindset with money? Like you said, are you using it to like get through the month and pay your bills?
Right.
Or are you using it more as a tool to give you advantages for things in the future,
And it's very interesting, especially with inflation. And I know that we actually talked about that a few months ago. I realized that the cost of things has increased dramatically, and so I do understand that, but that's when you really need to think about, okay, hopefully inflation, things will kind of start, leveling out a little bit, but what are you doing so that you're not continuing to create a future problem for you and your family? You accumulate a lot of credit card debt, that's going to strap you for the future. So yes, it might feel good to go get that compulsive buy here, right around the holidays or even back to school shopping or, going on a vacation. But if you plan for those kind of things, it really won't bother you. Something I always share with folks is if you're using your credit card and say you're going, oh, well, I don't have, a whole lot of money. I'm just trying to get through the last couple of weeks of the month or what have you, and you go in and you say, hey, I'm going to use this. I'm eating lunch every week or, oh, we're going out to dinner. This will be a little splurge. If you're not intending on paying that off at the end of the month, think about that. That meal just sustains you for how long? Probably a few hours, right? I'm hungry the next 4 to 6 hours.
Yeah.
But you're going to be paying on that debt and you tag on interest.
Right.
That meal that was $50 for your family of 4, you tag on, and interest rates on credit cards are anywhere from, the lowest ones I've seen are here at Centric, right? And so they start, anywhere between 11, 12, 13%. And I've seen them all the way up to 30 and 40%.
That's outrageous.
Yeah. So that's the thing I always share with people, your credit score is something that is so incredibly important. Everything you do, the way you spend your money, the way, whether you're saving or you're paying off quickly, even if you can't, I would say, even if you can't pay off a full debt, make a payment, do something there, but it's so incredibly important for us to make sure, that you're making those timely payments and just think about, like, is this a real necessity? Is this something you absolutely need? And you've made a plan to pay that off at the end of the month. Or you have a plan to pay something.
Right.
That's something that I always encourage folks, because not paying at all really, hurts your credit score. But when you can pay something, it doesn't hurt it as badly as it certainly could if you just avoid the payment altogether.
Right. So let's say once you have tanked your credit score, what does that mean for you in the future? Like, how does that tie your hands? What are you not able to do once your score, reaches below a certain point?
Well, so this is really interesting. We actually we pride ourselves on at Centric really helping members who are incredibly credit challenged. Some people think that bankruptcy is the only answer, and it's genuinely not the only answer. We believe in relationship lending at Centric. And while, for example, if we say, hey, you've got a goal of wanting to get you a car, okay? And you say, okay, I want this particular type of car. Well, do you have any cash that you might want to put down on that vehicle? Okay, so those are some things to think about. So you're looking at, that is a commitment, not only from you, that's your cash you're putting on that vehicle, and then we will come halfway and see what we can do for you, as far as helping you achieve where you're wanting to be with that. That does two things, really and truly. One, it shows us that you're really bought in, right? You have skin in the game. You'll hear people talk about that. The other side of that too is the more you're able to put down, the less you're having to finance, which means you're going to pay less for that particular vehicle. So one of the things, that I really try to share with folks too is just when they're thinking about this from credit and really managing, your credit score, there are ways to really enhance your score. And like I said, it depends on why your score is that way. Is it because you have opened up multiple, new lines of credit and you've maxed out all those credit lines? Or do you have credit lines that you have opened and maybe, you just have a balance on there and it's just been lingering for a period of time and you're just paying kind of what you can? It all depends for folks, but something that I would share is, what are some things you can do that would just like flip it upside down? One, call the creditors. Always stay in communication with who you owe. Just always do that. When they can reach you and you can reach them, it's a really nice relationship. Contact them and say, listen, I'm in a bind. Can we get in a payment plan? Because we talked about that revolving and an installment debt. Perhaps, if you don't have a really good mix of both installment and revolving, installment are those fixed payments. The revolving is that credit line where it just kind of fluctuates. So I would say maybe take a look at that. You sit down with a credit officer and they will actually take a look at it here at Centric and say, okay, maybe you have a whole lot of revolving, a lot of credit cards. Perhaps we can consolidate that debt, right, and put that into an installment. So then you're getting a good mix of credit. Just keep in mind, if you're closing out those scores, right, and closing out those cards or lines of credit in a short period of time, your score is going to be shocked, but you're going to trend upward, and that's what you want to see happen.
Right.
There's just so many different things that can happen there. If you don't have a mortgage, a lot of times you won't ever really reach your 800s. It's kind of challenging to do that. I would also say too, just be mindful, is this debt yours or are you a co-borrower with someone else? That's where we see a lot of our folks, really get into a financial bind with their overall financial trajectories because they've decided, hey, I want to co-sign on this vehicle, or I'll have someone as an authorized signer on my line of credit. And there's not a whole lot of control that you have in that.
Right. I mean, you're completely dependent on how the other person handles that at that point. Oh, yeah. So, I mean, there's got to be a lot of trust there.
It does. It really does. So you just have to think about it. There's several different situations. Are you on the brink of bankruptcy because you've extended yourself, overextended yourself, and every line of credit you have is completely maxed out? That's a conversation to have with the creditor, right? And I would definitely take a look at seeing if you can consolidate that particular debt, where you have the relationship, where your direct deposit is going. And us here at the credit union can really see, how you're managing your money throughout that month. That's critical because we're able to see, okay, we know what you're making, right? We know what you're bringing home and how are you managing that? Because not only whenever we're counseling you on what we can do from a loan side, we're building a budget for you.
Right.
Say, okay, can I really afford this new loan? Or this is the financial situation that I'm in, can't get a new loan right now, but we might be able to remove a few things for a short period of time so that you can start putting funds towards paying down your debt. And it's going to look a lot better. I've told this story so many times, when my husband and I got debt free. When we were first married and we had our first little girl, and we just had, a mound of debt, right? We had a vehicle, one was paid off, but one we actually still owed money on, and we had 2 credit cards and a student loan. So we had right at probably $15,000 in debt. Well, to some people, it does seem like a whole lot. And we had a mortgage at the time too, but what I'm talking about is, let's look at this debt that we can probably tackle. And I won't necessarily say this your highest interest rate. I don't really look at it in that regard. We genuinely here at Centric follow very similar to what Dave Ramsey has to offer, as opposed to, the snowball method. It's just what he has. We want you to get to the point where you can pay cash for a car, but we do realize that that is not necessarily, it's not realistic for everybody. And when referencing Dave Ramsey, I wanted to definitely say that. But what we actually did is that we just started tackling our debt from smallest to largest. And we just cut out everything, we cut out any extra dining out. We took our lunch to work. We ate at home all the time. We didn't have cable. We didn't have internet at our house. We just did a whole lot of different things that
Sacrifice.
we did, but it was for a very short period of time. And it was right at about 14 months that we were able to pay off that debt. We did not take on any promotions. We did not take on any new debt. We did add a child to our income. So we had 2 babies within this time frame, and one of which was very, very sick. So we accumulated a lot of medical debt for her. So it's a lot of things for us to really manage. And how do we work through that? We were still able to do that. Now, you work back up to that. We sold off a vehicle, we paid cash for a vehicle, but we got, just one to get us from point A to point B.
Right.
Didn't have air, there's no AC. We just kind of bare bones it. But I would never trade that time for anything, because it's something that really made us realize what can we achieve in life with doing without. And it's freeing, really, and to do that. And it makes you realize it's just like, this is a waste, but, everybody has their own thoughts and so forth. But the majority of the time when I sit down and talk with people, as far as over their credit and how are ways in which they can really improve it, it's their day-to-day spending.
And I think that's why it's so important to utilize the free financial counseling that we have here, because sometimes all it takes is just a fresh set of eyes on the money. Like, when it's yours and it's in and out of your account all throughout the month, sometimes you just need a fresh perspective to say, do you really need to do this 4 or 5 times a week?
And it really and truly, talking about finances too, and especially if you're looking at, like you just said, them a day in and day out, and every month you're like, oh my God. Then you start getting disgruntled. Days run out, you may get disgruntled about your job or your relationships with people, and it starts impacting all the things in your mental health and your well-being. And it's like, it's just not worth it.
No.
It's genuinely not. And like you mentioned, it's free to talk to us. It's completely free. So if you can't come to one of our locations, we always say, hey, we'll do it via Zoom. We can do that through our video banking, through, My Centric Connect. You name it. There's just even over the phone, and we can, securely email you your credit score if you want to see what that looks like. You get a free copy of your credit report. We give you a free copy of a budget. You name it. Why not do that?
Right. The tools are available.
Oh, yeah. Right here.
It's great.
Fingertips.
One thing I did want to talk about, so the different types of credit accounts. So we've talked about like mortgages and car notes and things like that, and then credit cards. Is there one that affects your score more than the others do?
So like we mentioned earlier, as far as the mortgage, having that on your credit report, that's a wonderful way for you. If you're paying in full, right? And on time.
Right.
Those are ways in which you can really achieve like what folks refer to as like a perfect score, so to speak. I will say this, there is not one product or other necessarily that is better or best. It's genuinely the relationship you have.
Mm-hmm.
It's the length of time that you've had those accounts open, right? Give it a little bit of life, that's what I always share with folks. The other side of it too is, as far as paying on time. So was why I mentioned about earlier, as far as the length of time that something's open. I still have my very first credit card. I've kept that open because that is when I first established credit. So my credit is dated back to when you had that very first line of credit, and whether that be installment or revolving debt, but that is when you establish credit. So I've kept that open. The length of time, obviously, and also too, the time in which you're paying. So if you're a late pay or no pay, that's going to impact your score drastically. So by talking about, it's really the relationship.
Right. And the behavior.
Yeah. And I mean, if you're late pay, no pay, it's going to cost you truly because you're going to pay more. So say, for example, Emma, you and I are buying the same vehicle, right? The exact same car or house even, whatever. Depending on if you have better credit than I do, you're going to come out better. I'm going to pay more for that very same house. Same way with utilities. A lot of folks, really struggle when they're getting started, say, hey, they're having to move. They're not prepared to pay different deposits and so forth. If you have a lower credit score, you're going to have to pay, a higher deposit. If you have a very high credit score and a positive overall credit rating, you may not have to pay a deposit at all.
Right.
So, those are some things a lot of times, it could be the difference between yes and a no of getting, whether that's that new loan or what that looks like. But here at Citric, when we're talking about these things, we don't want to give you a hard no. We want to explain the why. And if you still have this desire, then let's get you there.
Right. But we might have to take a couple extra steps along the way.
That's right. That's exactly right.
Yeah. That's awesome. I mean, and people appreciate that too. I think when you have a financial institution who's not just, it's not a hard no.
Right.
Like, no, I'm sorry. Try later. Try again later. It's not right now, but I can help you get to where you need to be so we can make it a yes.
That's right.
That's important.
It is very important. And that's why I always say, that's why I won't bank anywhere else. Because if I come across, if we have financial hardship or something like that, I want my funds to be here. I want them to know the relationship that I have with my money. And then if I need to be extended credit, I just feel confident that they will walk me through here and what it is that I need to do.
Right.
And not only that, you're going to pay your lowest credit score or even the lowest credit rating here as far as from an interest rate. And then if you have funds that you can say bring in every single month, we pay you just to have your checking account here.
Right.
Like the highest earnings and then also the lowest amount that you're going to pay back. It's just a no-brainer to me.
I agree for sure. Before we wrap up, is there anything else you wanted to add? Is there anything that we didn't talk about that you wanted to kind of mention?
No, I just really want to reiterate the importance of having a conversation with folks about this. It is literally one of the best decisions that you could ever make is when you just say, hey, I need to hit reset. And right now is the perfect time to do that. You just kind of start thinking about what are your overall goals? What does your really overall debt look like? And how do you move to the next step? You may not have a goal. You may not have a financial goal. Talk with one of our credit counselors. They'll help you do that. And it's free. You can talk to somebody, either by phone or even in person from 8 to 6 every single day. If you want to schedule an appointment to do that virtually, we can also do that. Our Live Better program is something that we work with our small employers where we actually we have a team of folks that goes into local employers and we host different workshops, and a gift that we offer to them is one-on-one with their employees to discuss budgeting and just do an overall financial health chat. And I highly advise that. You can reach out to us online. I know there's so much information too in our show notes that you'll be able to share, but please reach out to us, and just let us know how we can help. Talking through these kind of things is the best gift you can give yourself. So thank you, Emma, for having me.
Well, thank you for coming on. And really, really good topic. That wraps up another episode of the Live Better podcast, focusing on mastering credit health. We hope you've gained valuable insights to navigate and improve your financial well-being. Remember, your credit health is key, and Centric is here to support you on this journey. If you found this episode helpful, please subscribe, share, and leave a review. Your feedback shapes content that directly addresses your financial needs. Keep the conversation going on social media. Connect with us on Facebook at Centric FCU and on all other platforms at MyCentric. Stay updated on the latest insights and resources tailored to help you master your credit health. Centric is your dedicated companion on your financial journey. Thanks for being part of the Live Better podcast community. Until next time, take care and prioritize your financial well-being.